Venture capital is not for every type of business. It's a sexy industry. People talk about it a lot. We hear about it a lot, but it is not the only type of funding, which is why I'm here. Well, hi, everybody. Thank you so much for having me here. It's great to be here. We have an awesome partnership with On Deck, and I really love the On Deck Fellow program. So I'm so excited to meet you and to be here together. My name is Heather Buffo, and I'm here to talk to you about alternative forms of capital and raising with Republic. Oops. Okay, so just to tell you a little bit more about myself, I'm the Venture Growth and Partnerships Lead at Republic. I'm originally from Cleveland. I spent 8 years in Boston, including college, to get my degree. I moved to Austin in 2019. I gave up on the winter and migrated south to try on the tech startup life. My background is in nonprofits and education, and I have also done some writing and consulting work, and I'm currently a Notley Fellow. If any of you are in Austin or familiar with Austin, it's a social impact fellowship connecting for-profit professionals with nonprofits. And outside of my day job, doing wonderful presentations like this and working with awesome people in startups and VC, I love bikes and I love beer and I love money. So if you ever want to chat about fun things, those are the things I like to talk about. Okay, so what are we going to achieve today? 3 major questions we're going to answer. If we're going to talk about alternatives to venture capital, we should probably talk about what is venture capital, just as a little primer. And then we'll talk about what the alternatives are and where Republic fits among those, and then how Republic actually works. Okay, so let's just start real quick with a little primer on what is venture capital. All right, so venture capital is a type of investment that helps large growth scale businesses grow and scale. So the basic structure that you've probably heard of includes LPs and GPs. So limited partners give their money to general partners who then invest that money into companies. The most typical structure is the 2 and 20, where the general partner receives 2% of a management fee off of the assets under management, the total amount in the fund, as well as 20% of the profits. And then the the limited partners get everything else. Most VC funds are looking for at least a 3x return on their investment in order to be considered a good investment. And not all VCs do very well. There's a very strong principle here called the law of larger numbers that really dictates how venture capital investments work. Sorry, there's a dog barking outside my window. I hope it's not too loud. So the law of large numbers basically says that the more investments that you make, the better odds that you have of succeeding, which makes sense. And it's kind of like the Pareto principle on steroids. So if you know of this principle or the power law, it says that a small number of inputs account for a large percentage of the outputs. And so this has been proven in a lot of different systems and environments to be about 80-20, 20% of inputs account for 80% of outputs. In VC, it's even more extreme than that. About 4.5% of dollars invested generates more than 60% of a fund's returns. So it's very dramatic. So can't play or hate the game. And so what are VCs looking for when they invest? It's calculated risk. They are looking for scalable businesses. So just to be clear, venture capital is not for every type of business. It's a sexy industry. People talk about it a lot. We hear about it a lot, but it is not the only type of funding, which is why I'm here to talk to you about it today. But they're looking for scalable businesses with a large total addressable market. So I know that the On Deck Fellows, you all are pretty early stage. You may not yet be at your market analysis and fit. So when you get there, you'll hear about TAM, SAM, and SOM. You may already know these things. But VCs are really looking for a total addressable market, so to demonstrate a huge opportunity for where that business can get into. They're usually looking for revenues in the hundreds of millions of dollars, and they want companies to reach that unicorn status of $1 billion valuation. Typically, these investments work on a 5 to 7 year timescale. Lately, companies have been staying private a little bit longer, maybe 7 to 10 years. So it's definitely a long game. And at the end of that investment is the moment where there is an exit event like an IPO or an acquisition, which allows the investors to get a return. So when VCs are looking to invest in companies, they're asking themselves 3 things: why this, why you, and why now? This is something that you should be able to answer for any investor, not just venture capitalists. Anyone that you're talking to that wants to put money into your business, they want to know why this, why you, and why now. So keep those things in the back of your mind. So venture capital is definitely on the rise. Over the last 10 years, it has been steadily increasing as an asset class that's very popular in growing businesses. Last year, there's over $150 billion invested, which is very cool, but so is equity crowdfunding, or as we like to call it, crowd investing. So last year, $215 million was raised from over 1,000 companies, which is really exciting given that this has only been legal for 5 years, which I'll talk about in a minute. And it's been growing about 100% year over year. So it's a really popular way for companies to engage their communities. And last year, almost 50 companies raised the maximum of $1 million, which is pretty exciting. And that has gone up soon, and we have been able to contribute to a large number of those companies. And I'll tell you about that in a bit as well. All right, so now that we have a bit of an idea of what venture capital is and how it works, let's talk about what the alternatives are. So there are a lot of different classes of assets and ways to fund your business. One of the big ones that we'll just address really quickly is venture debt. Venture debt is a huge opportunity. There are more than 20 types of venture loans, and they fall into 4 major categories. So there are lines of credit, which fund short-term assets. There are term debt, which you can repay in installments over a short period of time, maybe 1 to 5 years. There's equipment financing. This is really popular in the life sciences, where there's research using really heavy duty equipment, which can help move that along. And then there are royalty monetization, which is also popular in life sciences. So I'm not going to get too deep into this particular class because it is so complex, but just to give you an idea, some of the benefits of venture debt are really great. It can really help you extend your runway to help you become cash flow positive if you're not there yet. It can, provide growth capital. It can reduce your equity dilution. It can help you bridge around. So if you are raising money at a particular valuation and then you have a dip in revenue and you don't want your next round to be at a lower valuation, called a down round, then you can use some venture debt to bridge those rounds and help you maintain a steady increase in your valuation. Venture lenders usually don't require board seats, and the due diligence process is typically less onerous than a venture capital term sheet negotiation. So lots of reasons folks like to use venture debt. Okay, so outside of venture debt, I have a couple examples here. Trinity Capital and Clearbank are ones you may have heard of. If you want to learn more about venture debt, Trinity Capital has a lot of great resources on their website, articles, very informative. I highly recommend those. So if you're not going one of those routes, VC or venture debt, what do you do? Most of you have probably heard about a friends and family round or angels. So this is a great place to start. These are the people that believe in you and really want to see you bring your dream come to life. So they are a good place to start. Angel investors are individuals who write checks typically starting at about maybe $1,000 all the way up to $50,000. Again, it varies depending on the angel, but they're called angel investors because they kind of fly down and help you get started with a big infusion of cash, which is really great. But we're not all made of money. We don't all have friends and family out here just running around with money to throw at our passions and let us quit our day jobs and do these crazy things that entrepreneurs do. So if that is not part of your plan, grants and competitions, I think, are the best next step. They are a way that you can get, again, non-dilutive funding for your company. Mostly no strings attached. There's no such thing as free money, but grants and competitions usually only have reporting requirements and an expectation that you'll keep your investors engaged. However, they're really there to help you support your goals. Competitions can also be a really great way to get exposure. SoGal Ventures has a global pitch competition, which can really help spur on your business. The Small Business Association, SBA loans, those are also a great way. They also do grants to get started. I highly recommend you look up your local SBA. And then there is something that we call bootstrapped VC, which is kind of a made-up term, but for a category of venture capital that provides investment opportunities that more closely align investor incentives and founder incentives to continue to grow the business. So Earnest Capital, Collab Capital, they have some of these really cool investment interest sims with cute names, but essentially, again, try to align those incentives. Indie VC is a really cool one that was led by entrepreneurs and for entrepreneurs. And sadly, you may have heard a couple weeks ago, they decided to close their fundraising for a variety of challenges. I highly recommend you read about that. But they still have 8 companies in their portfolio. They're growing pretty consistently. So I think there's some proof of concept there. We'll see. And then Chisos Capital is a really great organization that is led by one of our venture partners, which I can also tell you about later, William Stringer. That has an interesting revenue share agreement that allows founders to claw back some of their equity as they grow. So lots of different options there. Accelerators, you probably know a lot of the popular sexy ones like Techstars, Y Combinator, and 500 Startups. These are places that you go to grow your business and get a ton of support. So in exchange for helping you design your product, build out your model, and really grow your business, these companies, these accelerators tend to take a little bit of equity in your business. They can be industry themed, they can be founder themed. This one, Enrich Her, is great network for women and founders of color. And so there are lots of different types of accelerators that can be focused on helping you achieve your goals. And then there are CDFIs. This is a kind of little known resource. It stands for Community Development Financial Institutions. They can be banks, credit unions, and venture capital providers. And they are really focused on helping local communities create new business opportunities and help people come out of poverty. So really, really great resource there. I highly recommend. Again, you look at your local CDFI and see if that is an option for you. All right, and then the best category of alternatives to venture capital, I'm not biased, is crowdfunding. So there actually have several types of crowdfunding. I, of course, am going to tell you the most about equity crowdfunding with Republic, but you're probably more familiar with rewards-based crowdfunding. So Kickstarter and Indiegogo, these are organizations where you can put your business online, and people can invest in your business, but in exchange for that investment, they get some sort of perk. So it could be swag, it could be a pre-order of your product, but they don't get any equity stake or ownership in exchange. And so the relationship kind of ends after the perk is given. iFundWomen is another great rewards-based crowdfunding site that focuses on women founders. And then there's microloan crowdfunding. So Kiva is a really interesting organization that provides loans up to $15,000 at 0% interest, also sourced from the crowd, another really interesting resource. So when you think about all these alternatives, there's a lot to weigh. I won't spend too much time on this chart, but this is just a little summary of what each one might be able to contribute. They all have different pros and cons. Again, not every type of capital is right for every business, and not every type of capital is right for every stage. These are somewhat in order of, kind of early stage to later stage, not necessarily. But I will share this deck as well after this with Sarah so that y'all can see it. But just some things to consider, whether you want to give up equity, whether you need help with marketing, how it's going to appear in your cap table, all things that you should consider when you're thinking about these different forms of capital. Okay, so that was a lot of information. So where do you start? Your new business, you may not know like which of these things is the best option. So these are just some kind of quick tips I like to give folks, is really start by asking yourself a lot of hard questions. This takes a lot of planning, takes a lot of time. And so it's really important to be intentional about it. Why are you raising capital? What are you going to use the money for? Who are you going to raise it from? What type of capital do you need? How much are you going to raise? How much do you need now? How much might you need a year from now? How much you're going to need depending on how much revenue you have or how much staff you have? How much time do you have to dedicate to fundraising while you're also trying to keep your business alive and running? And how are you going to go about it? These are all really, really important questions you should definitely do before you do any kind of fundraising. I found this nice little flow chart on the Gust blog, which is another great resource. Full disclosure, did do a little bit of editing with Cheryl's help to put equity crowdfunding, I think, where it fits, which is here in the kind of intersection of cash and support, a little bit more on the cash side, but I'll tell you more about how we support our founders. So, tons of resources. I highly recommend you do your research, but really start with these important questions. And then once you have gone through that, what are some things that you should consider as you go forward? Again, these are kind of just some tips and tricks that are really helpful to founders. Determine your priorities and your terms. Do you want to give up equity in your business? Do you want to bootstrap this thing from start to finish and maintain complete ownership of your company? That might be something you want to consider. Refine your pitch. You should be able to talk about your business in just a few sentences. I know the elevator pitch thing is super annoying, but really every opportunity, you know this, you're an entrepreneur, every opportunity to tell somebody about what you're doing is an opportunity to get another customer, another supporter, another person. So you should be able to do this with investors as well. You should be able to make a very clear ask. If you just say like, well, I'd like to get as much money as I can and be really helpful. If you gave me that, that's not helpful to an investor. They're going to want to know what you're going to use the money for, why you are raising money. Again, going back to those questions we just talked about. Keep your capitalization table clean. This is so important to understand where each investor fits in the equity stake of your company. If you are going to give up equity, it's really important to have that really clear and understand where everybody sits. And then same thing with your data room. In order to make a good investment, there are, yes, of course, like I said, this Pareto principle and this, power law dictates a lot of the success, which is why a lot of investors cast a wide net. However, there are ways to see whether a business is doing well. And so seeing that you're measuring the right things to understand what success means for your business is really, really important. And then I cannot emphasize this one enough, but due diligence goes both ways. Getting into a relationship with an investor is kind of like dating. You are going to spend a lot of time together. You're going to make a lot of really important and difficult decisions together or not together. And so it's important to understand what that relationship is going to look like. These investors are going to do deep due diligence on you and on your business. There's no reason you shouldn't do the same on them. Talk to other founders that they've supported, understand where they're at, how they interact with you, and make sure that you are finding investors that are aligned with you, which leads me to my last point about making a targeted list of aligned investors. Again, not every type of capital is right for you. Not every investor is right for you. You need to understand who is going to help you best meet your goals. And so finding a list of folks that meet those mission alignments is really important. I've seen some really great lists where folks have done like a red, green, yellow scale of, really aligned, somewhat aligned, not aligned at all, which I think can be really helpful and shows that you've done your research and know who's a good target. Absent that, I have seen founders send me a list, like a male founder who sent me a list that included a bunch of funds for women-owned businesses. And so I was like, did you read about them at all? So, being able to be really clear about what you need and who might be able to meet those needs is really helpful. Okay, so we got through that part. Awesome. So many types of capital, really so many great resources, but equity crowdfunding is a really exciting one and one that's relatively new. So let me tell you about how it works with Republic. So if you're not familiar with Republic, if you showed up here kind of blind, that's okay. We are giving investors the power to invest in companies they believe in by offering amazing investment opportunities from amazing founders like you. We currently do this in 6 different verticals. We are continuously adding new expertise to our internal staff and are really excited about the opportunities that this presents. So how does it work and how are we able to do this? This all came about, like I said, only 5 years ago when Title III of the Jobs Act was passed. So the Jobs Act was originally passed in 2012 by the Obama administration to stimulate the economy following the Great Recession. And in order to create even more opportunities for companies to have access to capital and more opportunities for investors to grow their wealth, Title III was passed thanks to a collaboration of a lot of interested and passionate parties about investing, so that retail investors, people like me and you, can invest as little as $10 in private companies. So up until 2016, you had to be an accredited investor to invest in private companies. An accredited investor is someone who has a net worth of at least $1 million or has annual income of $200,000 or more. That is a lot of money. And so private investing was really restricted to allowing the wealthy to get wealthier. And so this opportunity now allows anybody, regardless of their accreditation status, the opportunity to get these huge returns. Again, high risk, high reward investing, but the SEC is really working hard to both protect investors and create opportunities for people. So when this was passed in 2016, we developed Republic. We were spin out of AngelList. Our CEO, Ken Wynn, he was general counsel at AngelList, and they seeded him to start this online platform. So this investment opportunity is specific to investing through a registered online platform, such as Republic. The primary instrument through which we can do this is the crowd safe. So you may be familiar with the Y Combinator safe. It stands for a simple agreement of future equity. And it essentially means that investors are investing at a discount in your company at the current valuation, such that at a later exit event like an IPO or an acquisition, they are entitled to an equivalent amount of stock. The economics are really simple. Founders have control and are able to negotiate their terms with us, and it's very customizable. So it's a really flexible instrument. And what Republic provides is the legal and technological infrastructure to allow you to take advantage of this exemption. So you may have heard that there are a bunch of changes that came into effect just last Monday. They were announced in November, and they are really some awesome rules that are going to continue to open up opportunities both for investors and founders to get more investments. So some of the ones we're really excited about is now founders can raise up to $5 million on our platform. Which is really exciting. And I'm proud to report that we were successful in completing the first $5 million raise with Gumroad last Monday. They raised it in about 9 hours, which was really impressive. And Backstage Capital was close behind them. Backstage Capital was the fastest to $1 million before this came into effect. They raised that in about 12 hours, and they finished the $5 million raise last week. So that is one of the biggest updates. Some other ones that are new things, I won't spend too much time on what it used to be, but currently you can also use Republic to do what is called testing the waters, where you can state your intention to raise a campaign and get some commitments ahead of time, some soft commitments, and see if you have enough momentum to do a really successful campaign. You can also make demo day solicitations. So if you're doing a demo day and you have a campaign live, you can actually tell people, which previously was not allowed. So there are a lot of exciting opportunities that we're really hoping will open up more avenues, particularly for underrepresented founders, to access bigger networks and be able to fund their businesses more easily. So what makes this such an exciting opportunity? It's really that Republic sits at the intersection of financing and marketing. So not only can you get a cash infusion into your business, but you also are able to get a lot of exposure. You're able to access our member network of now over 1 million individuals and have some other great opportunities for press exposure, offering rewards to your investors. There are just tons of benefits to a Republic campaign. What it looks like, this is a very high level overview, but essentially before your campaign starts, our due diligence is pretty quick. We set you up for success as much as possible. During your campaign, you have access to our network. We throw in some performance marketing on your behalf. You can interact with your investors. It's a really dynamic experience. And then after your campaign closes, you have access to all of our issuer perks. So issuers are what we call the companies raising on our platform. They're issuing securities. We have, partnerships with places like Amazon Web Services that are able to offer, and HubSpot to offer you discounted products for your business. And then we do our best to support you in your ongoing fundraising efforts by making introductions, and you have access to our Republic community. So this includes our Republic Venture Partners, which is an amazing community of individuals who are really mission aligned with our mission to democratize access to capital. And there are some on deck fellows joining us soon. I won't spoil it, but I'm very excited about our new cohort who we'll be announcing soon. So how do we select companies to raise with us? We have some basic eligibility requirements. You have to be incorporated in the US, and you have to have some runways that your business survives a campaign. These are SEC regulations that we cannot get around. And then the rest, we are flexible on. We generally look for companies that are post-product and post-revenue. Showing that you have some traction demonstrates that you have some crowdfundability, that you're able to bring in the initial dollars into your campaign and really get it started and going. And then we can help you build off of that. We look at team. We want to know who's leading this, what kind of industry expertise do you have in what you're trying to offer, and your product, of course. What's the quality of it? What problem are you trying to solve? How good is your solution? These are all things that we consider. These are things that lots of investors consider, VCs consider it. We look at this as well, but these are kind of the primary things that we focus on. So just to give you a quick overview of the process, it's pretty straightforward. Our due diligence process, like I said, it's very quick. Our investment committee meets every week to review companies that we have all of their information on to determine who to offer a campaign agreement to. A campaign agreement is a non-binding document that just states your intention to raise with us and the terms. And then you start onboarding after a couple weeks, and that takes about 4 to 6 weeks. We build your deal page off of your deck, you edit it, and in the meantime, we get your financials GAAP compliant, reviewed by a CPA. An attorney helps you file your Form C with the SEC, and then you launch. Most campaigns are about 90 days, but the timeline is very flexible. So we can't do this without our amazing, amazing team. We look at your team, you have to look at our team. So this is our incredible investment team who helps us get companies up to the launch point. So Caitlin and Rohan, our amazing business development team, they'll start with an initial call to understand where you're at and see if you're a good fit. Michaela has joined us from NextSeed. That's one of the verticals that we acquired through an acquisition of a company last fall. So they specialize in venture debt for small and Main Street businesses. And then Jeannie and Kyle are our incredible due diligence team who will get all of the important details about your business to present to our investment committee. And then Matt is our fearless leader, really helps us with strategy and thinking about how we can support our founders and find more dynamic raises to go on our platform. Brooke Robbins is our portfolio relations lead. So once you are in your campaign and after it's completed, she helps folks get connected with investors, access these issuer perks I mentioned, and really, continue to support our founders. We do take an equity commission off of each raise, and so we have a vested interest in your success. And so Brooke is one of the many people that helps us support you in that. And then finally, if you are a person who identifies as a woman or a female founder, SheWorks is an awesome organization of a network of about 20,000 women founders. It's a free membership. We have weekly office hours and events and fireside chats, and it's a really great resource. So Veda helps us manage that program, and I highly recommend you check that out. So big question, just kind of wrap us up, that we get from a lot of founders is, can I still raise from venture capital while doing equity crowdfunding? And the answer is an enthusiastic yes. We are a complement to VC. We are not anti-VC. Some people come to us because they don't want to do VC. That's fine. Some people come to us and they're doing a VC raise at the same time as a Republic campaign, and that is also fine. The nice thing about a Republic campaign, like I said, it's very flexible. So, if you end up closing on more capital on your round earlier than you thought you would, you could close your campaign early. If you don't end up raising what you thought you were going to, you can extend your campaign. Really, we are able to, you're not limited to other types of security offerings you can make. And the CrowdSafe really, allows you to have that on your cap table separately from other fundraising sources. So just to give you a sense, after all that, where are we today? We have made over 300 investment offerings across all of our verticals. About 250 of those have closed so far on over 250 million in capital, which is pretty awesome. We have, again, over 1 million members in our network, and our campaign success rate is over 95%. That is something that we're very proud of. The reason that we're selective about the companies we put on the platform is because we want you to be successful. And so we're not going to put you through the effort and work and stress of trying to get a campaign to be successful if it's not going to work out well. So we really try hard to make sure that if not every campaign that we support is successful on our platform. And it is a much higher campaign success rate than our competitors. Just mention that. So, okay, ton of information. What do you do now? If you think that this is right for you, again, I know that y'all are very early stage, so you might not quite be ready for equity crowdfunding, but when you think that time might come, think about, again, your goals, what kind of capital you need. Does this fit into your fundraising plan and your timeline? Where do we fit into it? And where might these other types of capital fit into it? If you have any questions or you need any help figuring that out, let me know. This is how you can get in touch with me. If you have other questions about crowdfunding in addition to equity crowdfunding, on Mondays, my colleague Cheryl, who's here, and I, as well as our colleagues Rohan and Caitlin, who you saw earlier, have been doing these Monday Ask Me Anythings with some founders who have done both rewards and equity crowdfunding. And we literally just have people come up to the stage and ask questions, and it's been an education for me, so I highly recommend it. You can find me on Clubhouse there, and then I can point you towards it. And I will stop there and take questions.
Awesome. Heather, thank you so much. And just want to say, love your energy. I think it's really nice to see on a Thursday morning. So great presentation. We have a few questions in the Slack channel. So would love for you guys to come up and ask directly to Heather. Chip, if you want to come off mute and ask your question to start us off.
Yeah, sure. Hey, Heather, nice to meet you. I'm also in Austin.
Good.
So
yay!
happy to have you here. question was, I've got a friend who is using Fairmint and cafes to raise money right now. So I'm curious, how does that relate to Republic and safes?
Fairmint. I'm actually not familiar with that. Can you tell me more about it?
Yeah, I mean, what I know about it is that he is, so it's fairmint.co is the URL, and they're using a cafe format or product, which just let me go back to it really quick. It says the safe reinvented, of course. So the safe reinvented, meet the cafe, continuous agreement for future equity. And anyway, so it sounds like you might not yet be familiar with it. So maybe my question isn't going to be as useful right now.
Yeah, well, I appreciate you bringing this to my attention because this is really interesting. Yeah, I think I'd have to read about it a little more, but I'm not exactly sure about how that differs from the safe, but this is really cool.
The one thing I would say is, from what I understand, he's doing is a lot of like he called it like Twitter hustling. So basically, like rather than having a platform where it would be listed, it was more about getting something in front of people that would know them or be interested in them, and then invest that way. I don't know if that makes any different or differentiates it at all, but that is kind of the limit to what I know about it so far.
Okay, cool. Yeah, I mean, just from taking a quick glance at the website, it looks like just another avenue for collecting a large number of investments. I think really that's what the safe is about, is not directly buying equity right at that moment, but having an agreement for basically a promise for a discounted equity in the future. So if you want to send me an email, I'd love to like read a little bit more about that, and then maybe I can give you a more thorough answer.
Thank you.
Yeah. All right.
Thanks, Chip. Next up, we've got Wyatt.
Thanks. Hey, Heather. I'm just up the road in Dallas, so your neighbor to the north.
Awesome.
A lot of Texans on the Zoom. Thank you very much for the overview. It's super cool to learn about all the things you guys are working on. I have two questions. The first is, it'd be great to hear just in your own words what the business model is for Republic, sort of sources of revenue, just to have like a mental model for how you guys are structured. And then you alluded to some sort of standard high-level terms that are, generally market for when you partner with an organization. So anything you could share about what that looks like would be really great too.
Yeah, sure. So on the regulation crowdfunding campaigns, we take a 6% cash and 2% equity, or 2% securities commission from each campaign. So currently that has been our structure to date. We have to have the same terms for all our companies. Since the $5 million cap has increased, we are able to offer a tiered structure in certain cases. So we're always willing to talk about that. So that's the primary way that we make money in regulation crowdfunding. We also, like I said, have a lot of different verticals. So we have a crypto arm, which our founder and much of our founding team is very steeped in the crypto world. And so they do both offerings for crypto companies. They also do help companies set up coin offerings and do some advisory services. So that's another way that we make money. Real estate also has a very different structure in terms of the way that they pay out investments. Investors in real estate opportunities are able to get dividends or quarterly payments. I'm less familiar with that side. But so to quickly answer your question, 6 and 2 is what we do with startups using the regulation crowdfunding exemption. And then we have some other streams as well. And I'm sorry, what was your second question?
What high-level terms that are in the crowdfunding, which the 6 and 2 model helps to understand it too.
Oh, so a lot of our companies, are you talking about in the crowd safe?
That's right.
A lot of our companies, again, it's customizable. So every company chooses something different. Most of our companies, I would say, probably average about a $10 million valuation, and tend to offer like a 20% discount, and raise at a valuation cap. So if you go onto republic.co/companies, you can see right on we call it a deal card, which is a little box that shows each investment opportunity. It gives a quick summary of the terms. And then once you go onto the campaign page, you can see the terms on the right side. And and then the Form C, which has all the detailed information that you have to report to the SEC. So we are, now that this $5 million cap is in place, so we're hoping to have some larger companies that have larger caps. So we expect that to go up soon. But that's generally how people have structured their safes.
Cool. Thanks.
You're welcome.
Thanks, Wyatt. Next up, John Mark.
Good morning, Heather. Thank you. Love your energy and the broad overview before diving into Republic. So thank you for that. I grew up near Tyler, Texas, so another Texan here.
All right.
My question relates to traction. I'm launching a connected hardware product, and we're very early. So our initial plan was get it out into the market, prove interest first, prior to engaging someone like Republic. And I was just wanted to get your general thoughts on when to engage and how much traction to have. And our initial thoughts, hardware product, high tooling, high NRE. So there's a hurdle cost to get the first manufactured run out there. The current plan was raise from angels to develop the product, launch it on rewards-based crowdfunding. The angel money plus the rewards-based crowdfunding should be enough to ship the first product. At that point, then we've generated some buzz, we have some sales, and it's okay, here, now that we've actually delivered something, this might be a good time to hop on Republic. But I've seen people super early, and I've seen people much later. So I'd just be curious on your thoughts of the physical world and what sort of traction does well on Republic.
Yeah, great question. Just, at that little summary, it sounds like you have a really clear plan of what you're doing. So, I mean, that sounds great to me. In terms of traction, it varies for every type of business, because traction for a software company doesn't look the same as a CPG company. We generally, so some of the proxies that we use are about 10K MRR plus. And on average so far, the companies that we've hosted have had about 650K in trailing 12-month revenue. We don't look for that benchmark. We're not okay, if you haven't met this, you're not ready. That's just kind of what companies have looked like to date. As you said, we have done, pre-revenue all the way to, more developed, and Gumroad is now 10 years old. So it varies. We have had a lot of companies have success doing rewards-based crowdfunding first and then coming to Republic. And usually that's because they're able to engage that group of folks. They're able to get a really good proxy for how well that campaign can do. And I think I'm not, I've never done rewards-based crowdfunding myself, but I think it is just a little bit cheaper and a little bit less intensive than an equity crowdfunding campaign, just in terms of the preparation. And of course, both take a lot of marketing and really putting your product out. So those are some of the things that we look at. I'm trying to think. Yeah. And then, other ways that we gauge traction are the engagement level of your community. So maybe you're not producing revenue yet, but you have a really engaged social media following, or maybe you're B2B and you only have a few contracts, but they are continuing to purchase new products and help you stimulate business. So it really varies on the product, but there are a lot of different ways we look for traction. If you are thinking that maybe you might be ready or you're really not sure, you can always reach out to us and we can give you a pretty quick answer. Our business development team, they are very skilled and very smart and have looked at hundreds, if not thousands of companies at this point. And so they can pretty quickly tell, whether a company is maybe at the right stage for Republic. And we, can give you an answer quickly, so you don't have to go through a whole process and then find out it's not ready. Like I said, our due diligence process, if it does go a little bit further than business development, then we're able to have our investment committee meet every week and can give you a quick answer. And oftentimes, if there are companies that, it looks like there's good promise for, a crowdfunding campaign, we can start the conversation early and then check back in a few months if it's not quite the right time, and then start it when it is right.
Okay, super useful. Thank you so much. Then just quickly, I guess, pre-sales versus actual shipped product, how does that play into the decision as well? I'm assuming the shipped product is much more a favorable case for traction than I'd be curious, how do you look at pre-sales?
Yeah, usually we look for a product first. Again, not a hard and fast rule. If you have a wait list of 1 million people, or whatever is the appropriate number that would be particularly compelling for your product, then we can take that into consideration. We do have a company, I think, launching soon that has not yet sold their products, but they have a really long wait list for pre-sale. So, again, it kind of depends on the product, but we can kind of look at both things.
Sure. Awesome. Thank you so much. Really helpful.
Yeah, no problem. And send me an email, and if you have a deck, you can take a look.
Cool. Thanks.
Yeah.
Thanks, John Mark. Great question. Lawrence, you have your hand up.
Yeah, it's actually related to the question that was just asked, but for the companies without revenue, I was curious what has worked the best, especially, in our case, it's a pretty capital intensive upfront investment. And then also, if we're targeting certain markets for the product, do you all with the outreach also try to help target those markets for the investors?
Yeah, good question. So to the first question, in terms of pre-revenue companies, it's kind of hard to answer again, because it just really depends on the market. For capital intensive organizations, they tend to have a lot of success with venture debt because they can help, support that capital intensive startup cost. And sorry, I just blanked on your second question. Oh, about targeting certain markets. Yes. So when we do performance marketing on your behalf at the beginning of your campaign, we do A/B testing and we give you all those results. So we're able to try to figure out if we can target those investors more specifically. We do have a certain amount of information on our investors that we try to use for retargeting. We do email drip campaigns. So there are lots of ways that we can assist with that work. And then once you have some investors already on your campaign, I kind of blaze through it, but on your deal page, again, if you go to our republic.co/companies, any company that you select, you'll see a little menu right under their promotional video that has like their investment page and then a discussion page. And so every investor that invests in your company is asked to leave a review after they make their investment as to why they invested. And so it's a really great way to get, quick feedback. And then you can interact with those investors and you can find out, am I getting a lot of people who have experience in this industry, or am I getting people who just believe in my mission? A lot of founders have found it really valuable to get that really instantaneous feedback as to why people want to invest and can leverage that going forward.
Great, thanks.
Yeah.
Thanks, Lauren. Lawrence, excuse me. Chip, you have another question.
Yeah, I did. So my other question was about thinking about the pressure to drive towards a liquidity event versus like traditional VCs who are looking at a specific time horizon. So how does that look, feel, et cetera, when you're raising from instrument like Republic?
So I'm sorry, can you repeat the last part again?
Well, my guess is, I should say, that there's a different kind of set of assumptions or pressure around getting to a liquidity event, going like using something like Republic versus accepting money from a traditional venture investor.
Yeah, that's a good question. I mean, I guess it kind of depends on your cap table overall. So in terms of just the Republic investor specifically, part of the way that the CrowdSafe is able to aggregate a lot of investors onto your campaign is that those investors do not get information or voting rights. So we ask that all of our companies provide updates to their investors at least quarterly. And there are some reporting requirements with the SEC. But really, those investors are relatively low maintenance. Most of our companies do choose to engage their investors to different degrees. That's one of the perks that a lot of people like to offer for different investment levels. It's like, if you invest $1,000, you get a thank you note. If you invest $5,000, you get a group call. If you get, $10,000, you get a one-on-one call, things like that. So in terms of the pressure for a liquidity event, I don't know, I guess it depends on how you interact with your investors. Again, we are taking a 2% equity stake or in the form of securities offered from each campaign that raises with us. So, we want our investors to have some sort of exit. Sometimes companies will choose to create a different trigger event. And so that SAFE will convert earlier than an exit event. So I'm not sure how to really quantify or describe the pressure aspect, but it is every investor should understand that they will get their investment after there is some event that creates liquidity. I don't know if that helps answer your question at all.
Yeah, I mean, I think it sounds like it depends, which is
Yeah. Yeah, I
about,
know. I hate the answer. It depends. It's so annoying and not helpful, but you know, it really, again, it kind of depends on the industry as well. I think it's helpful for founders to include those kinds of projections into their deal page. You know, like just like if you're talking to a VC, you'd probably talk about what are your exit strategies if you are planning to get acquired or IPO. Again, this is it is equity crowdfunding, but it is a venture style investment. So we are looking for large returns after a 5 to 7 to 10 year scale. So, you know, because I guess what I should say is that because the investors don't get information or voting rights, they don't get to necessarily steer the direction of your business in the same way that a VC might be a little more hands-on. So that might kind of factor into that pressure metric. But if you're not a business that's looking to get acquired or an IPO or do some sort of large exit, then it's probably not a good fit for equity crowdfunding either.
can I ask one quick follow-up question? Because I've got a couple of like chat messages on the side going that are just trying to clarify what the 6 and 2 was that you mentioned as part of your business model.
Yeah. So on each campaign that raises with us, 6% of we take a 6% cash commission off of your total raise amount, and that's only if you reach your minimum goal. So if you raise $100,000, we take 6,000, and then we also take 2% in the form of security. So we include ourselves on that line on your cap table.
It's 2% of that raise, right?
Yes. The security is offered through your Republic campaign at the same terms as everyone else.
Okay, cool. Thank you.
Yeah. What else you got?
Great questions, guys. Keep them coming. We've got about 10 more minutes left. Jesse, if you'd like to ask yours.
Hey, thanks for taking the time. I was curious if you had any data on the frequency with which you see follow-on investments into your crowdfunded investments, and how that compares to companies that have raised through mostly, traditional VC.
Yeah, so most of our companies have done later follow-on rounds. They've done it with VCs or they've done it with other different instruments. Some of them have gone on to accelerators and other opportunities. So I don't have like off the top of my head exactly like how many or at what valuation, but I think most of them have done up rounds. I think we've only had maybe 1 or 2 down rounds. And again, it kind of depends on what kind of capital that companies are looking for afterwards. But we do our best to make sure that we're connecting companies with those opportunities. And then once those rounds become public, we support them in the press and try to promote them in our networks as well. So we've had follow-on investments from places like Luro Hippo and Cheryl, I don't know if you can think of others off the top of your head, but we have a lot of institutional investors that are really on board with our mission and are supporting us in ways that we really appreciate as well. So I can probably find some more detailed information. I don't have off the top of my head, but a lot of companies have been able to do that as well.
The reason I was asking, sorry, David. The reason I was asking was because I've seen some investors, right? Not saying it's right for them to do this, but for some investors to kind of cast aspersion on companies that raise through equity crowdfunding, right?
Yeah.
And my hope was that there would be some data-driven way of showing, hey, in fact, these companies are having no harder time continuing to raise money than the companies that didn't raise equity crowdfunding.
Right.
So that was kind of like the thought process there, and I don't know if there's any data that might like dispel that myth or that idea.
Yeah, for sure. So yes, absolutely. There are definitely still some VCs out there who are like, equity crowdfunding is for bad companies that can't get VC investment, which is total BS if you ask me. But it happens. And again, I think it goes to kind of the larger point of like, when you're thinking about your fundraising journey, where do these things fit in? And I think for a lot of companies, equity crowdfunding is an attractive opportunity because they want to engage their community. They want to give an opportunity for their customers, their family, whomever it is, to invest in their business and kind of push their mission forward. So if that's something that's important to you, that can make crowdfunding attractive. Some people think that throwing up a you can just like throw up a campaign on Republic and like you can just sit there and money will just flow in. Same with rewards crowdfunding. Like people think that you just put on Indiegogo and people will find it and invest in you. That's not how it works. It does a lot of work. It does require a lot of time. Some founders have said it's like a second full-time job. So I will not lie to you about that. It definitely is a ton of work. But again, it is a really unique value proposition to your audience. So understanding if that's something that your audience is going to want to do, that is going to factor into whether that is successful. If that's important to you and that aligns with your mission, if there are investors who don't agree with that, then that's probably not a good fit for you either. So I think it's really important to weigh those really critically and not just say like, oh, well, this is the best kind or this is the worst kind, or like, you know, again, like VC is very sexy and gets a lot of attention, but there are lots of different reasons why people like different types of capital. In terms of, Cheryl just reminded me, other follow-on investments that we've had. So there's a company called Hemster that does, helps retailers provide custom alterations. And they did a campaign with us, and then Bullpen actually led their Series A after seeing them on our platform. We also had another company, they're kind of coming to me now, called Sapient, which is an Internet of Things company. Jason Calacanis directly asked for an introduction to the founder after he saw the campaign on Republic. So there are a lot of investors. Some people think that Republic, like, oh, it's for non-accredited investors. So it's all just like, you know, my grandma and my nephew who are like trying to do something interesting, and then they don't know anything about investing. Actually, a lot of people are trying to build their angel investing portfolios through Republic to demonstrate, you know, their values, what it is they want to invest in, and kind of experiment with investing as well. So a lot of our investors are pretty sophisticated. I don't actually know the proportion of accredited versus non-accredited, but we have, you know, a plethora of both. So there are lots of different ways that, you know, that you can engage new and different types of investors through a campaign and afterwards. I hope that did I answer your question? We can talk about it more later if that didn't.
Thanks, Jesse, and thanks, Heather. David.
Cool. Heather, thanks for this chat. It's super informative. I am a member of Republic, although I haven't made any investments yet. Question for you, and I think you just started to touch on some of it, which is, what kind of value are you getting from the potential crowd investors over the long term, right? I know this is obviously a different model than traditional VC, but is either Republic or potentially some of your crowd investors actively involved in, I hate to use this word, the value add that happens after the fact? You know, what does that relationship look like?
Yeah, I think it's different for every company and what they want to get out of that investment body of folks. Some people, you know, will look at kind of their broader, like all the people that invested through the Republic campaign and, you know, cherry pick individuals who might comment and say like, I have, you know, industry expertise in this particular thing. Again, because your investors don't get information or voting rights, there's no guarantee. We tell investors like, there's no guarantee that you're going to have, you know, a close relationship with the founder. And for founders, it's totally up to them how much they want to engage their investors, if they want to, you know, find strategic partners within that, or if they kind of want to just carry that equity with them and then give their investors updates. So it's really up to each company. I would say, I wouldn't say that Republic or equity crowdfunding really advertises itself as like a, you know, we are a value add in the sense of like the crowd of investors have any particular value add. Us as Republic, we think our value add is that we help to drive up to 70% of the investment volume of your campaign. So strictly in like an acquiring cash perspective, that is the value that we provide through our platform and through our audience. And then again, you know, during and after your campaign, if you're continuing to fundraise, getting really specific feedback from y'all about what you need, and then tapping our network to figure out who can help you, whether it's our venture partners or, you know, other investor partners, accelerators, whomever it is. You know, we do our best to like really make sure that you have access to those opportunities, again, because we have an interest in your success as well. So it depends on the founder, but you know, there are lots of different ways that you can leverage that network.
Great, thanks.
Mm-hmm. Want to give a quick thanks to Heather for the session today. It was really awesome to have you here, and thank you for your time.
Thank you guys so much for having me. Good luck, y'all, and please email me or send to the chat if you have any other questions.
Amazing. Thank you so much, Heather. Enjoy the rest of your day, guys.